In today's world, credit plays a crucial role in personal finance. It is essential for high school students to understand the concept of credit, how it works, and its implications for their financial future. Credit refers to the ability to borrow money or obtain goods and services with the promise of repaying the borrowed amount at a later date, usually with interest. In this reading, we will explore the key aspects of credit, including the parties involved, types of credit, and the terms and costs associated with credit transactions. In any credit transaction, there are two main parties involved, the creditor and the debtor. The creditor is the individual or institution that lends money or extends credit to the borrower. This can be a bank, credit union, or other financial institution. The debtor, on the other hand, is the person or entity that borrows the money or receives the credit. The debtor is obligated to repay the borrowed amount according to the terms and conditions agreed upon with the creditor. There are several types of credit available, each with its own characteristics and purposes. Let's explore the main categories of credit: secured credit, unsecured credit, closed-end credit, and open-end credit. Secured credit is a type of credit that is backed by collateral. Collateral is an asset pledged by the debtor to the creditor as security for the borrowed amount. In the event that the debtor fails to repay the debt, the creditor has the right to seize the collateral to recover the outstanding balance. Common examples of collateral include homes for mortgages and vehicles for auto loans. Secured credit often comes with lower interest rates compared to unsecured credit because the presence of collateral reduces the risk for the creditor. Unsecured credit, on the other hand, is not backed by any collateral. The creditor relies solely on the debtor's promise to repay the borrowed amount. Examples of unsecured credit include credit cards and personal loans. Due to the higher risk involved for the creditor, unsecured credit typically comes with higher interest rates and stricter qualification requirements compared to secured credit. Closed-end credit refers to a loan or credit arrangement with a fixed term and a specific amount borrowed. The debtor receives the entire loan amount up front and is required to repay it in regular installments over a predetermined period. Examples of closed-end credit include auto loans and mortgages. Once the loan is paid off, the credit agreement ends and the debtor must reapply for a new loan if additional credit is needed. Open-end credit, also known as revolving credit, is a type of credit that allows the debtor to borrow funds up to a predetermined credit limit. The debtor can continuously borrow and repay the funds as long as the credit limit is not exceeded. Credit cards and lines of credit are common examples of open-end credit. Unlike closed-end credit, open-end credit agreements do not have a fixed term and the debtor can borrow and repay funds as needed as long as minimum payments are made and the credit limit is not exceeded. When engaging in credit transactions, it is crucial to understand the various terms and costs associated with borrowing money. Let's explore some of the key concepts related to credit terms and costs. The principal refers to the original amount borrowed from the creditor. It is the base amount on which interest is calculated and does not include any additional fees or charges. For example, if you take out a $10,000 loan, the principal is $10,000. Understanding the principal is essential because it directly impacts the overall cost of borrowing and the amount of interest paid over the life of the loan. Interest is the cost of borrowing money, and it is typically expressed as a percentage of the principal amount. Creditors charge interest as compensation for the risk they take in lending money and the time value of money. The interest rate can be fixed, meaning it remains constant throughout the loan term, or variable, meaning it can fluctuate based on market conditions or a predetermined index. Interest is calculated based on the outstanding principal balance and is usually compounded, meaning that interest is charged on the principal and any accumulated unpaid interest. The frequency of compounding, e.g., daily, monthly, or annually, can significantly impact the total amount of interest paid over the life of the loan. An installment refers to a regular payment made by the debtor to the creditor to repay the borrowed amount. Installment payments typically include a portion of the principal and the accrued interest. The amount and frequency of installment payments are determined by the terms of the credit agreement. For example, a car loan may require monthly installment payments over a 60-month term. Installment payments help debtors manage their debt by breaking down the total amount owed into smaller, more manageable payments. However, it is essential to understand that longer loan terms may result in lower monthly installments, but a higher total cost of borrowing due to the accumulation of interest over time. A finance charge encompasses all the costs associated with borrowing money, including interest, fees, and other charges. Common finance charges include annual fees, origination fees, and late payment fees. These charges can significantly increase the overall cost of borrowing and should be carefully considered when evaluating credit options. Creditors are required to disclose the finance charges associated with a credit agreement in a clear and transparent manner. The Truth in Lending Act, TILA, mandates that creditors provide debtors with key information such as the annual percentage rate, APR, total finance charges, and payment schedule before the debtor commits to the credit agreement. Before entering into a credit agreement, it is crucial for debtors to thoroughly review and understand the terms and conditions of the agreement. Credit agreements outline the rights and responsibilities of both the creditor and the debtor, including the principal amount, interest rate, payment schedule, and any fees or penalties associated with the credit. Debtors should carefully read and comprehend the credit disclosures provided by the creditor. These disclosures, required by law, provide essential information about the cost of credit, such as the APR, finance charges, and any potential penalties for late payments or default. By understanding these disclosures, debtors can make informed decisions and avoid unexpected costs or consequences. Understanding credit is a vital skill for high school students as they prepare to navigate the world of personal finance. By familiarizing themselves with the concepts of creditors, debtors, types of credit, and the terms and costs associated with credit transactions, students can make informed decisions and build a strong foundation for their financial future. It is essential for students to approach credit responsibly, understanding that borrowing money comes with obligations and consequences. By carefully evaluating credit options, reading and comprehending credit agreements and disclosures, and managing debt responsibly, students can establish a positive credit history and set themselves up for long-term financial success. As high school students begin their journey into adulthood, a solid understanding of credit will empower them to make sound financial decisions, whether it be financing their education, purchasing a car, or eventually buying a home. By mastering the concepts outlined in this reading, students can confidently navigate the world of credit and lay the groundwork for a prosperous financial future. As high school students approach adulthood, understanding the process of qualifying for credit becomes increasingly important. Whether you're planning to finance your college education, purchase a car, or rent an apartment, having a good credit history and credit score is essential. Your credit history is a record of your past borrowing and repayment behavior. It includes information about credit accounts you've held, such as credit cards, loans, and mortgages, as well as your payment history on these accounts. Lenders use your credit history to assess your creditworthiness and determine whether to extend credit to you. Several factors influence your credit history. Payment history. This is the most critical factor, as it shows whether you have made payments on time or have missed or late payments. Length of credit history. A longer credit history provides lenders with more information about your borrowing and repayment habits. Types of credit used. Having a mix of different credit types, such as credit cards and installment loans, can demonstrate your ability to manage various forms of credit responsibly. Credit utilization. This refers to the amount of credit you are using compared to your credit limits. Keeping your credit utilization low, ideally below 30%, can positively impact your credit history. Recent credit inquiries. When you apply for credit, lenders make inquiries into your credit history. Too many inquiries in a short period can negatively affect your credit history, as it may suggest that you are taking on too much debt. Credit bureaus, also known as credit reporting agencies, play a crucial role in the credit qualification process. In the United States, there are three major credit bureaus: Equifax, Experian, and TransUnion. These agencies collect and maintain information about your credit history, which they provide to lenders and other entities in the form of credit reports. Credit reports contain detailed information about your credit accounts, including account balances, payment history, and credit limits. They also include personal information, such as your name, address, and social security number. It's essential to regularly review your credit reports to ensure that the information is accurate and up to date. You are entitled to one free credit report from each of the three credit bureaus every 12 months. Credit scores are numerical representations of your creditworthiness based on the information in your credit reports. The two most common credit scoring models are FICO and VantageScore. These scores range from 300 to 850, with higher scores indicating lower credit risk. Factors that affect your credit score include payment history, credit utilization, length of credit history, types of credit used, and recent credit inquiries. Maintaining a good credit score is crucial for qualifying for credit at favorable terms. A high credit score can help you secure lower interest rates, higher credit limits, and better loan terms, while a low credit score can make it difficult to obtain credit or result in less favorable terms. Building and maintaining a positive credit history is essential for qualifying for credit. Here are some strategies to help you establish and improve your credit. Make payments on time. Consistently making on-time payments is the most important factor in building a strong credit history. Set up automatic payments or reminders to ensure you don't miss any due dates. Keep credit utilization low. Try to keep your credit card balances low relative to your credit limits. High credit utilization can negatively impact your credit score, so aim to use no more than 30% of your available credit. Avoid excessive credit applications. Each time you apply for credit, a hard inquiry is made on your credit report. Too many hard inquiries in a short period can lower your credit score. Only apply for credit when necessary and avoid opening multiple accounts in quick succession. If you have limited or no credit history, you may find it challenging to qualify for credit on your own. In this case, using a cosigner can be a helpful strategy. A cosigner is someone who agrees to take responsibility for the debt if you fail to make payments. This person is typically a parent, guardian, or another trusted individual with a strong credit history. Having a cosigner can increase your chances of being approved for credit and may help you secure better terms. However, it's important to understand that cosigning carries risks for both parties. If you miss payments, the cosigner's credit will also be negatively affected, and they will be responsible for repaying the debt. Another option for building credit is to explore alternative credit options. Secured credit cards, for example, require you to make a cash deposit that serves as collateral. The credit limit is usually equal to the deposit amount, and your payment activity is reported to the credit bureaus, helping you establish a credit history. Credit builder loans are another alternative, where the loan amount is held in a savings account, and you make monthly payments to build your credit. Once the loan is paid off, you receive the funds from the savings account. Qualifying for credit is a crucial aspect of financial planning for high school students. By understanding your credit history, the role of credit reporting agencies, and strategies for building and maintaining a positive credit profile, you can set yourself up for success in your financial future. Remember to regularly review your credit reports for accuracy, make payments on time, keep credit utilization low, and avoid excessive credit applications. If you have limited credit history, consider using a cosigner or exploring alternative credit options to help you establish a credit record. Building a strong credit history takes time and responsible financial management, but the benefits are well worth the effort. With a good credit score, you'll have access to better loan terms, lower interest rates, and more opportunities in your personal and professional life. As you navigate the world of credit, be sure to educate yourself on best practices and seek guidance from trusted sources when needed. By taking control of your credit now, you'll be well prepared to face the financial challenges and opportunities that lie ahead. Credit cards have become an essential financial tool for many people. They offer convenience, security, and the ability to make purchases even when you don't have cash on hand. However, managing credit cards effectively requires understanding key concepts such as APR, grace periods, and credit limits. APR, or annual percentage rate, is a crucial term to grasp when dealing with credit cards. In simple terms, APR is the yearly interest rate charged on your credit card balance. It's essential to understand that APR is not a one-time fee, but rather a continuous charge applied to your outstanding balance. When comparing credit cards, it's important to look at their respective APRs. A lower APR means you'll pay less interest on your balance over time, making it easier to manage your debt. On the other hand, high APR cards can quickly lead to mounting interest charges, making it difficult to pay off your balance. It's also worth noting that some credit cards offer introductory APRs, which are usually lower than the regular APR and last for a specified period. These can be attractive options, but it's crucial to understand how the APR will change after the introductory period ends. To minimize the impact of APR on your finances, it's best to pay your credit card balance in full each month. By doing so, you can avoid interest charges altogether. If you do carry a balance, making payments above the minimum due can help you pay off your debt more quickly and save on interest in the long run. A grace period is a window of time between the end of your credit card's billing cycle and the payment due date. During this period, you can pay your balance in full without incurring interest charges. Grace periods typically last around 21 to 25 days, giving you time to review your statement and make a payment. It's important to note that grace periods only apply if you paid your previous month's balance in full. If you carried a balance from the previous month, interest charges will begin accruing immediately on new purchases. To take advantage of your grace period, it's crucial to pay your balance in full each month. This habit not only saves you money on interest, but also helps you avoid falling into a cycle of debt. If you don't pay your balance in full within the grace period, you'll begin accruing interest charges on your outstanding balance. These charges can add up quickly, making it harder to pay off your debt over time. Additionally, failing to make at least the minimum payment by the due date can result in late fees and potential damage to your credit score. A credit limit is the maximum amount of money you can charge on your credit card. Credit limits are determined by the card issuer based on factors such as your income, credit history, and debt-to-income ratio. Your credit limit plays a significant role in your credit utilization ratio, which is the amount of credit you're using compared to your total available credit. This ratio is a key factor in determining your credit score. Generally, it's recommended to keep your credit utilization below 30% to maintain a healthy credit score. To effectively manage your credit limits, it's essential to keep your balances low relative to your total credit limit. High credit utilization can lower your credit score and make it more difficult to obtain credit in the future. If you find yourself consistently near your credit limit, consider requesting a credit limit increase from your card issuer. A higher credit limit can lower your credit utilization ratio, positively impacting your credit score. However, It's crucial only to request an increase if you're confident in your ability to manage the additional credit responsibly. On the other hand, exceeding your credit limit can lead to over-limit fees and potential damage to your credit score. If you find yourself in this situation, contact your card issuer promptly to discuss your options and create a plan to bring your balance back under the limit. Understanding APR, grace periods, and credit limits is essential for anyone looking to manage their credit cards effectively. By grasping these concepts and implementing smart strategies, such as paying balances in full each month, keeping credit utilization low, and responsibly managing credit limits, you can use credit cards as a valuable financial tool while minimizing the risk of falling into debt. Remember, credit cards are not a substitute for income or a license to spend beyond your means. They require careful management and a commitment to responsible use. By educating yourself on these key terms and adopting sound financial habits, you can enjoy the benefits of credit cards while maintaining a healthy financial future. Taking out a loan is a common financial decision that many people face at some point in their lives. Whether it's for buying a car, paying for education, or starting a business, loans can provide the necessary funds to achieve one's goals. However, before taking out a loan, it's crucial to understand the various aspects involved, including the types of lenders, loan terms and conditions, and borrower rights and protections. When seeking a loan, borrowers have several options for lenders, each with its own characteristics and requirements. Traditional banks and credit unions are the most common sources of loans. These institutions typically offer a wide range of loan products, such as personal loans, car loans, and mortgages. They often have strict eligibility requirements, including credit score minimums and income thresholds. However, they also tend to offer competitive interest rates and repayment terms. Consumer finance companies are alternative lenders that specialize in providing loans to borrowers who may not qualify for traditional bank loans. These companies often have more flexible eligibility requirements and faster approval processes. However, they also tend to charge higher interest rates and fees compared to traditional lenders. It's essential to carefully review the terms and conditions of loans offered by consumer finance companies before accepting them. Loan sharks are illegal lenders who offer loans at extremely high interest rates and often use intimidation and violence to collect payments. They target vulnerable borrowers who are unable to secure loans from legitimate sources. Borrowing from loan sharks is highly risky and should be avoided at all costs. Not only are the interest rates exorbitant, but borrowers may also face threats and physical harm if they are unable to repay the loan. When taking out a loan, it's essential to understand the various terms and conditions associated with the loan agreement. A down payment is an initial payment made by the borrower at the time of purchasing an item or property. It represents a portion of the total cost and is typically required for secured loans, such as car loans or mortgages. The purpose of a down payment is to reduce the overall loan amount and demonstrate the borrower's commitment to the purchase. A higher down payment generally results in lower monthly payments and may also help secure better loan terms. A balloon payment is a large lump sum payment due at the end of a loan term. Loans with balloon payments typically have lower monthly payments throughout the loan term, but require the borrower to pay off the remaining balance in one large payment at the end. Balloon payments can be risky for borrowers who may not have the financial means to make the large final payment. It's crucial to carefully consider the affordability of a balloon payment before agreeing to such a loan. An acceleration clause is a provision in a loan agreement that allows the lender to demand immediate repayment of the entire loan balance under certain circumstances. These circumstances may include missed payments, default, or a breach of other loan terms. If an acceleration clause is triggered, the borrower must pay off the loan in full or face legal consequences. It's important for borrowers to be aware of acceleration clauses and to carefully review their loan agreements to understand the potential consequences of non-payment. An add-on clause is a provision in a loan agreement that allows the lender to add additional products or services to the loan, such as insurance or warranty coverage. These add-ons can significantly increase the total cost of the loan. Borrowers should carefully review any add-on clauses and consider whether the additional products or services are necessary and worth the extra cost. To help protect borrowers from unfair lending practices, there are several laws and regulations in place that outline borrower rights and protections. The right of rescission is a legal provision that allows borrowers to cancel certain types of loans within a specified time frame after signing the loan agreement. This right typically applies to home equity loans, refinanced mortgages, and some types of credit transactions involving a borrower's primary residence. Under the Truth in Lending Act, TILA, borrowers have 3 business days to rescind the loan agreement without penalty. This provision gives borrowers an opportunity to reconsider their decision and back out of a loan if they have second thoughts. The Truth in Lending Act, TILA, is a federal law that requires lenders to disclose key information about loan terms and cost to borrowers. This information includes the annual percentage rate, APR, total loan costs, and repayment terms. TILA helps borrowers compare loan offers and make informed decisions about borrowing. Lenders who violate TILA provisions may face legal consequences, including fines and lawsuits. In addition to the right of rescission and TILA, there are other laws and regulations designed to protect borrowers from unfair lending practices. The Fair Debt Collection Practices Act, FDCPA, regulates the behavior of debt collectors and prohibits harassment, false statements, and unfair practices in the collection of consumer debts. The Fair Credit Reporting Act, FCRA, ensures the accuracy and privacy of consumer credit information and gives borrowers the right to dispute incorrect information on their credit reports. Taking out a loan is a significant financial decision that requires careful consideration and understanding of the various aspects involved. By familiarizing yourself with the types of lenders, loan terms and conditions, and borrower rights and protections, you can make informed decisions and avoid potential pitfalls. Remember to carefully review loan agreements, ask questions, and seek guidance from trusted financial professionals when necessary. With the right knowledge and preparation, taking out a loan can be a useful tool for achieving your financial goals.